Friends, welcome to our today's session. Previous session, we have understood that depreciation under income tax law is charged on block asset concept. That means various assets are grouped under certain blocks, and different rates of depreciation are applicable to each such block. Let me show you the screen so that you can understand it. We had seen this, we had discussed all this thing in the previous class. Second, show you. Just give me a second. Yeah, these are various blocks we had discussed in our previous class. I remember block 1, building which are used mainly for residential purposes except hotel, houses, etc. Depreciation rate is 5%. Like this, under building, you see there are two blocks are there under building and rates of depreciation are charged. Furniture, there is only one block, you see depreciation rate is 10%. Plant and machinery, 30%, 50%, 45%, and in this case you see 30%, then again 30%, 40%, 30%, 8% like this. Rates of depreciation varies. Okay, you see block 8 is 40%, block 9 is 15%. So you see for different blocks, different rates are charged, but general rate for plant and machinery is 15%. Computer you see 40%. So this is called as the block asset. That depreciation is not charged individual assets. It is charged on a group of assets called as blocks. Okay. Ships you see, these are the blocks, block 1, block. Rate is 20%. And intangible assets are depreciated at the rate of 25%. And a few related points on depreciation also we had discussed. If the asset is acquired during the previous year and if it is put to use for less than 180 days, that means not full depreciation, half of the depreciation will be charged. Okay, for example, let us say one car is acquired in the month of August. If it is acquired in the month of August, it is used more than 180 days. Okay, because from August to March, you have to calculate August to March. It's more than 180 days and full depreciation will be charged. Okay, but let us say same car is, let us say it is purchased in the month of December. Then it's used for less than 180 days. Then not the full depreciation, half of the depreciation will be charged. Okay, because this is the year of acquisition, asset is put used for less than 180 days. Right? So this point you have given in mind. And points also I had discussed that these 2 points, remember, then we'll see an example, then it will be better for you, will be better understanding that will help. You see, when closing WDV of a before depreciation is negative, closing WDV is negative, such negative values shall be treated as short-term capital gain. Okay, if the block's closing value is negative, it shall be treated as short-term capital gain. But now you might with each situation it will become negative. So example. Then one more point you have to remember. In closing WDV block of asset before depreciation is positive or zero. It's not negative, it's either zero or positive. But block is empty. Is empty means there is no asset in them. All the assets are sold out. In that case, this positive value shall be treated as short-term capital loss. Okay, so if your negative value is short-term capital gain and positive value is short-term capital loss when block is empty. These two concepts will remember, but you'll be able to understand these 2 points only of examples. Right? As I told earlier also, there are views on depreciation and tax planning channel where this concept has been explained in detail on internet. Now, already know that in case of depreciable asset, there is a possibility of short-term capital gain and short-term capital loss. Meaning, there will not be any long-term capital gain or long-term loss, even if the asset is held more than 36 months. Even if it is held for long period, it will not be, the capital gain will not be considered as long-term capital gain or long loss since asset is a depreciable asset. This point. So to keep, right. Many times, many assets purchases assets on higher purchase scheme and higher purchase system. Right. They pay money in installments and asset is acquired on higher system. In this case, income tax law allows depreciation on cash equivalent price. Suppose a car is purchased on higher purchase basis, but the cash equivalent price of the car is 6 lakh rupees. So depreciation will be chargeable on 6 lakh rupees. Right? This point also you have to know. Now, to understand the situations, that in which situation there will be capital gain, short-term capital gain, in which situation there will be short-term capital loss. To understand that thing, we have to take into consideration various situations. In fact, here I have listed out 10 situations. These 10 situations will be explaining you in which situation there will be short-term capital gain and which situation there will be short-term capital loss. Just have a look at this question. Okay, question is of course relatively long, but let us just quickly have a look at. But when you when you look at the solution, it will be more clear to you. Question talks about like this: A, B, and C are three assets which form a block. That means block consists of these three assets. Rate of depreciation is 15%. Right? WDV means, can anyone tell me what is WDV? Can you tell me? That stands for written down value. Written down value on 1st April 2020 is 10 lakh. Compute depreciation in following cases. These are the different cases it is given. First case, machine A is sold for 4 lakh on 5th July or 15th July. Second case, machine D is purchased on 19th August 2020 for 6 lakh and machine A is sold for 1 lakh. One by one we have to see what is the situation. First you see machine A is sold for 4 lakh on 15th August. Let us see how to deal with that. Here this format, you just have a look at this format. Opening WDV in the question says is 10 lakh. It is given in the question. There is no addition, but machine is sold for 4 lakh rupees. So closing WDV is 10 lakh minus 4 lakh, 6 lakh rupees. Depreciation, you know, is 15%. So on this 6 lakh rupees, 15% will be charged, and the closing WDV after depreciation is 5 lakh 10,000 rupees. Okay, there is no short-term capital gain, there is short-term capital loss. Because block exists, there are three assets in the block. Only one asset is sold. Block is exist, and the closing WDV you see positive. Okay, understood? The closing WDV is negative. I will again take you back to this slide. What we have learned, if the closing WDV of the block before depreciation is negative, then there will be short-term capital gain. And when it is positive, but block is empty, then there will be short-term capital loss. This concept you have to keep it in mind. Okay, second situation you see, machinery D purchase. One other machine is added for 6 lakh rupees and machine A is sold for 1 lakh. When the machine is purchased, 19th August. That means even the additional machine is used for more than 180 days during the previous year. So full depreciation will be charged. In that case, how to deal with? Case 1 was over. Case 2, you see, opening WDV is 10 lakh given in the question. Addition 6 lakh rupees. Money receivable from sales 1 lakh rupees. This is added. This is sold. Closing WDV is 10 lakh plus 6 lakh minus 1 lakh. It comes to 15 lakh. Depreciation is charged on this entire 15 lakh, 15%, lakh 25,000. So closing WDV after depreciation is 12 lakh 75,000. Right? Hope you have understood why depreciation is in the entire asset, entire amount of 15 lakh. Because this particular additional asset is also used for more than 180 days. Therefore, full depreciation is charged. Okay, now let us see the next question. Third talks about Machinery D purchased on 12 December 2020. When it is purchased for 12th December, that means it is used for the month of maybe December, January, Feb, and March. To calculate number of days, it is less than 180 days. That means the machine B, which is purchased on 12 December, it is put to use for less than 180 days. Consequently, 50% of the depreciation will be charged. Okay, and the cost of machine is 3 lakh rupees. And machine B is sold on 2nd February for 6 lakh rupees. Okay, this also you have to take into consideration. Now let us see what is the solution to case 3. Opening WDB, same 10 lakh rupees. Addition 3 lakh rupees given to you in the question. And also this addition is for less than 180 days. Okay. The money receivable from sales 6 lakh rupees. Closing WDB you see comes to 7 lakh. But the 7 lakh rupees includes 3 lakh rupees for the asset which is put to use for less than 180 days. So for 3 lakh rupees, we'll charge half of depreciation. Okay, so 3 lakh rupees, how much will be charged? 15% into half. And the balance 4 lakh rupees, how much will be charged? Entire 15%. So this is how depreciation can be computed, as you can see here. Okay, total depreciation comes to 82,500. How 82,000? On 4 lakh, 15%, plus on 3 lakh, 15% into half. Total comes to 82,500, and the closing WDB is 6,17,500. I think we are understanding the point. Now let us see the fourth situation. Situation 4. Situation 4 is like this. Machinery E purchased on 15th December for 5 lakh rupees, and machinery A is sold on 5th May 2020 for 20 lakh rupees. Let us see what is the situation, what is happening here. Let us see case 4. This is the solution to case 4. You see, WDB is print WDB is 10 lakh rupees. Addition is 5 lakh rupees. My sales is 20 lakh rupees. So if you calculate 10 lakh plus 5 lakh minus 20 lakh, now closing WDB before charging depreciation is negative. Closing WDB before charging depreciation is negative. Hence, no depreciation will be charged. But the 5 lakh rupees which you got extra, how extra you got? Effectively, your WDB is 15 lakh and you are getting 20 lakh rupees. The extra 5 lakh rupees, which is negative, is in fact your capital gain, and that should be booked as short-term capital gain. I think you have understood this concept. This is called as short-term capital gain. So now you have understood different situation, how depreciation amount can be different, how one can have short-term capital gain also. Now, case 4 is over. Now let us look at case 5. Case 5 talks about machinery ABC sold for 1 lakh, 2 lakh, and 3 lakh respectively. And you already know the block consists of ABC. 3 assets are there. And the opening WDB is 10 lakh. So 3 assets. Question number case number 5 says all the 3 assets are sold. Let us see the computation of case 5. You see, opening WDB is 10 lakh rupees. There is no addition. Entire assets are sold for 6 lakh rupees. Closing WDB is positive. Normally, when closing WDB is positive, we are supposed to charge depreciation. But in this case, there is no asset. Block is empty. And therefore, depreciation will not be charged. Rather, this 4 lakh rupees, which is the closing WDB before depreciation, shall be treated as short-term capital loss. Meaning, the asset which is worth 10 lakh rupees is sold for 6 lakh rupees is a loss of lakh rupees. But since these are depreciable assets, this is not a long-term capital loss, this is a short-term capital loss. I think you have understood this concept. Now let us move to next case, case number 6. Case number 6, you see, it talks about machine D was purchased on 8th August 2020 for 1 lakh, and ABC was sold for 3 lakh rupees. That means all assets are sold and new asset was purchased. Let us see. Yeah, case number 6, you see. Opening WDB 10 lakh. Addition during the year 1 lakh. Money receivable from sales 3 lakh rupees. Closing WDB is 8 lakh rupees. On that 8 lakh rupees, depreciation will charge normal rate 15%. It comes to 1,20,000 rupees. The closing WDB after depreciation is 6,80,000 rupees. Simple concept. In this order, in this format, depreciation is computed normally. Let us look at case number 7. Case number 7 talks about, you see, machinery E was purchased on 19th December 2020 for 2 lakh rupees and ABC was sold for 2. Okay, E was purchased and ABC are sold. Let us see the impact. Case number 7. You see, opening 10 lakh, addition 2 lakh, on the sales 2 lakh. So closing is also 10 lakh rupees. So on this 10 lakh rupees, how will charge depreciation? This addition was purchased sometime in December. That means it is for less than 180 days. So for this 2 lakh rupees, we'll charge half of depreciation. So lakh into 15% into half. And on the remaining 8 lakh, we'll charge the full depreciation, that is 15%. Okay, then the total depreciation comes to 1,35,000. It is computed here. 8 lakh into 15% plus 2 lakh into 15% into half. So after charging 1,35,000 depreciation, the closing WDV is 8,65,000. Let us look at case number 8. 8 talks about machinery A, B are sold for 3 lakh and 5 lakh respectively on 7th November 2020. Machinery E purchased for 1 lakh on 15th July 2020. Okay, let us see the impact of this. Case number 8, I think we're talking about. Case number 8, if you see, the opening WDB is 10 lakh, addition is 1 lakh, sales is 8 lakh rupees, closing WDB is 3 lakh rupees. Okay, on this 3 lakh rupees, depreciation is to be charged. Since addition is also put to use for less than 180 or more than 180 days, then full depreciation. So entire 15%, that is 45,000 will be depreciation and 2,55,000 will be the WDV after depreciation. Let us have a look at case number 9. Machinery E purchased for 50,000 on 10th July 2020. Okay, July means it is used for more than 180 days. And the same is put to use on 15th December 2020. You know, under income tax law, what is important here is the date on which asset is put to use. So we have to calculate use from that date. And that date is 15th December 2020. If it is 15 December 2020, then asset is used for less than 180 days. So the treatment will be like this. Case number 9, we are looking at opening WDB 10 lakh, addition 50,000. There is no sales. Closing WDB 10 lakh 50,000. Depreciation charge. On this 50,000 rupees, you see half of the depreciation is to be charged. Because even if asset is acquired for more than 180 days, acquired in the month of July, it is put to use in December. So asset is used for the purpose of business and profession less than 180 days. So consequently, 50% of 15,000 plus on the remaining 10 lakh rupees, 15%. So total depreciation comes to 1,53,750 with charge. And the closing WDV after depreciation is 8,96,250. Now, friends, case number 10. 10 talks about machinery D purchased for 7 lakh on 7th August 2020, but the same is sold for 9 lakh on 17th December 2020. That means in the same year, asset is purchased and also sold. Let us see the treatment. Case number 10. Opening WDB 10 lakh, addition 7 lakh, sales 9 lakh rupees, closing WDV 8 lakh. On this 8 lakh, depreciation shall be charged 15%. Okay, 15%. It comes to 1,20,000 rupees, and the WDV after depreciation is 6,80,000 rupees. Okay, so this is how depreciation will be treated. And also we have seen in which situation there will be short-term capital gain or short-term capital loss. Of you got detailed idea of different situations. Now friends, next concept about depreciation we need to learn is about the concept of additional depreciation. It is specific to some industries and some plants. Additional depreciation is allowed on new machinery or plant, but other than ships and aircrafts, which are acquired or installed after 31st March 2005, and by the assessee who are engaged in the business of manufacture or production of particular thing, or in the business of generation, transmission, or distribution of power. So for these specific industries, if they acquire some plant and machinery, and that too after the 1st March 2005, then additional depreciation at the rate of shall be allowed. One thing, if that new asset is for 180 days, then 50% of additional depreciation, 10% will be allowed. It's normal depreciation plus additional depreciation. So with that, what will happen? Profit of the business will be coming down significantly, less tax burden. So broadly, I had explained you the concept of additional. There are certain specific areas where the additional depreciation is allowed at the rate of 30% also, 35% also. Normally it is 20%. It's allowed even when block is negative or nil, allowed only in the first year, not in the subsequent. That is the concept of additional depreciation. But additional depreciation is also not allowed under building, furniture, ships, aircraft, transport vehicles, office appliances, second-hand or old assets, plant and machinery which are eligible for 100% depreciation, scientific research, assets, etc. Plant and machinery installed in the office, residence, guest houses. All these things are not eligible additional depreciation. And also additional depreciation is not allowed as it is installed and sold in the same year. That situation also, additional depreciation will not be allowed. Textile goods manufacturers can claim additional depreciation on windmill. This is a case law for that. Okay, and some related concepts also. If there is a super construction on the leasehold land, then depreciation can also be claimed on that super construction if that is used for business and profession. And the expenditure relating to the transfer shall not be deducted for depreciation, shall be deducted from sales consideration for computation of short-term capital gain. Okay. If some expenditure is incurred for transfer, that will be deducted from sales consideration. That will not be considered for depreciation. In case of amalgamation of the company, demerger of the company, or succession of a public company into liability partnership, etc., depreciation shall be allowed to both the entities in the ratio of number of days. That means, let us say, amalgamating company and amalgamated company, they may distribute depreciation on the basis of number of days. Okay. And the benefit of date of amalgamation. So date, let us say when amalgamation has happened, that date, the benefit of date, that date shall go to the amalgamated company or resulting company. This is the new company. New company will be get depreciation benefit for the date starting from amalgamation date, including the amalgamation date. and the old company shall get the benefit up to the date of amalgamation. And one has to ensure that the total depreciation shall not exceed the depreciation calculated in prescribed rate if succession, amalgamation, demerger, conversion had not taken place. That means total depreciation will remain same, and that total depreciation is going to be distributed between these two companies on the basis of number of days, and the benefit of date of amalgamation shall be allowed to the amalgamating company, or in case of demerger, to the resulting company. There are certain specific situations when we find it difficult to arrive at the actual cost of assets. Actual cost is relevant because depreciation will be computed on that basis. Right. So expenses on acquisition, installation, etc. shall be added to actual cost. Suppose machine is purchased and some installation cost is incurred. That will also be added to the actual cost. Subsidy which is received from government shall be subtracted from actual cost. Okay. To that extent, the actual cost shall be lower. Indirect taxes which are eligible for ITC, that is input tax credit. Suppose you have purchased an asset and you have paid GST on that, and you are eligible to take input tax credit on that GST. Right? So that shall not be included in actual cost. Suppose cost of asset is 1 lakh, GST is 18,000 rupees, total asset cost becomes 1,18,000. But you will be able to get depreciation only on 1 lakh rupees. Indirect taxes shall, which are not eligible for ITC or not claimed forms a part of actual cost. If you do not claim ITC or you are some reason not eligible for ITC, then indirect tax can be included in the value of actual cost. When machine, equipment, etc. purchase, there might be some expenditure on trial run. This trial run expenditure shall be capitalized. That means the value of the asset shall be increased to that extent. To that extent means to the extent of expenditure incurred on trial run. And in case through that trial run, some output has been produced and that is sold out and some revenue is generated. So that is an income. So any such income by way of sale of trial product shall be subtracted from the cost of asset. But let us say asset cost is 1 lakh rupees, but in trial run you have generated a revenue of 10,000 rupees. So actual cost will be 1 lakh minus 10,000. This is how you can arrive at the cost. Yeah. In case of gifted assets, the cost of asset shall be the cost to the previous owner reduced by depreciation, as if the asset was the only asset in the block. That means we have to take the previous owner's cost and reduce by the amount of depreciation. By doing that, we will be arriving at the actual cost. If a personal building was there and which is later on brought to business as a business asset, then how to compute the actual cost? In that case, actual cost of the building shall be reduced by notional depreciation. That means you have to imagine that what would have been the depreciated value of that building, and that will be taken as the cost of the building. Okay, mind you, this provision is only for building. For all other assets, original cost can be treated as the cost of asset. Yeah, relating to depreciation, one more point is relevant, that is carry forward or setup of depreciation. If depreciation could not be absorbed due to sufficient profit or whatever reason, then this unabsorbed depreciation can be carried forward. Meaning, if in a previous year profits or losses chargeable are not sufficient to give full effect of depreciation allowance, the unabsorbed depreciation shall be added to the depreciation allowance for the following year and shall be deemed to be the depreciation allowance of that year. So it can be carried forward. Okay, how long? Indefinitely. There is no time limit for carry forward of On terms of depreciation, it can be carried forward indefinitely. That's the good thing about depreciation. Now, one more interesting concept we to learn regarding depreciation is the effect of depreciation on deferred tax asset and deferred tax liability. I think some of you might have heard these two terms, DTA and DTL, deferred tax asset and deferred tax liability. Let us see. You see, because of depreciation, there is a possibility that your book profit shall be different from taxable. Because when you compute book profit, you compute depreciation according to the useful life of the asset, depend upon the kind of entity that we are talking about. Suppose entity is a company, then useful life is defined or indicated in the company's law. Accordingly, we compute depreciation. But under income tax law, depreciation is computed on block asset concept. So depreciation might be different. Company law rate of depreciation might be different. Under income tax law rate of depreciation might be different. And because of this, the profit under income tax law, which we call it as the taxable profit, may be different from your book profit or accounting profit. So first possibility is that book profit may be higher than taxable profit. If book profit is higher than the taxable profit, that means taxable profit is lower. So you pay less tax now. Now you are paying less tax because your taxable profit is low. But in future, you will be definitely paying more tax. Okay. Because future, the situation will reverse. Why the situation will reverse? Because when you charge depreciation, let us say initial year, you charge more depreciation on income tax. Next year, since you WDV, depreciation amount will be less. So there will be time when you will find now income tax depreciation is more, but after some years, income tax depreciation will be less and the accounting depreciation will be more. Okay. So if you are paying less tax now, that means you are ready to pay more tax in future. Okay, since you are ready, by doing this, you are liable to pay more tax in future. You are creating a liability which is called as the deferred tax liability. That means you are deferring your tax liability for a certain period. So this is how high depreciation will lead to creation of deferred tax liability. On the other hand, if book profit is less than taxable profit is less than taxable. In that case, what will happen? Taxable profit is more. You are paying more tax. If you are paying more tax means you will be paying less tax in future. Okay, since you will be paying less tax in future, it creates an asset that is called as deferred tax asset. Okay, right? So in which situation there will be deferred tax asset? The taxable profit will be more. Taxable profit will be more when rate of depreciation is high. So high rate of depreciation will lead to deferred tax asset. So when doing business planning, we need to keep these things in mind. So friends, this was the concept of depreciation and related tax planning. With this depreciation uh, uh, part is over. There are few more business expenditures. So, and there is one more residual section also, section 37. So section 36 deals with other expenditure, other business expenditures. And 37 deals with some residuary expenditures. So both the things are important. And section 35 also contains a series of expenditures which are allowed as business expenses. So we'll be learning next session, we'll be covering all these things. Section 35, 36, 37, we plan to cover. Thank you very much. We'll catch up in the next session. Thank you, friends.